There isn't a more clickbaity news headline that is being thrown around every time there is a larger market move than mentioning how X amount of money has been added or erased from the market in a single day. The number is more often than not in the billions in case of indexes such as the SPX or even large single stock names like Nvidia. It grabs attention as people think that the money is actually real and it has been moved in or out of the market, but this is far from true. And let me tell you why. Because what is being referred to here is not cash that has physically entered or left the market. It is simply the change in market capitalization, which is nothing more than the last traded price multiplied by the number of shares outstanding. When a stock or index moves lower, the headline does not mean billions of dollars have been destroyed in the same way money is destroyed in a fire. It means that the price at which the last share traded is now lower than it was before, and when that new price is applied across all outstanding shares, the total implied value is lower. That distinction matters a lot. A stock does not need billions of dollars of actual selling to erase billions of dollars of market cap. Sometimes a relatively small amount of aggressive selling, or even a thinner order book, can move the marginal price enough to reprice the entire company or index. The same goes for large increases as well. The headline number sounds enormous because it is meant to capture the scale of the repricing, not the actual cash flow. To make this more concrete, imagine a simple market with an imaginary stock that has 10 shares outstanding, each last traded at 10. The market cap is therefore 100. Now suppose only one shareholder is willing to sell and you come in and buy that single share, but you're willing to pay 100 for it. Instantly, the last traded price becomes 100. Nothing else changed. Only one share traded and only $100 exchanged hands. Yet by definition, the market cap is now 10 shares times 100 equals 1,000. On paper, $900 of value has just been created, even though only one trade actually took place. This is exactly how marginal pricing works. The entire market is continuously repriced based on the most recent transaction, even if that transaction is small relative to the total size of the market. The price at the margin sets the value for everything. Now add another layer that is often overlooked. Those marginal trades that move prices are frequently driven by derivatives and leverage. In other words, the capital required to move that marginal price is often even smaller than it appears. You might not even need the full $100 in cash to buy that share. You could borrow it, use margin, or replicate the exposure through options or other leveraged instruments. So the chain looks something like this. A relatively small and often leveraged flow moves the marginal price. That marginal price is applied to all outstanding shares. Headlines report massive changes in value. And this leads to an even deeper flaw in how people interpret these numbers. Market capitalization completely ignores liquidity. It assumes, implicitly, that all shares could be sold at the last traded price, but that is almost never true. In reality, if every shareholder suddenly tried to sell, the price would not stay at 100 in our example. The market would have to walk down the book, hitting lower and lower bids, and the realized price would likely be far below the last print. So when you see a market cap of 1,000 in that example, it does not mean you could actually extract $1,000 from the market by selling all shares. It just means that the last marginal trade happened at a price that, when extrapolated, implies that valuation. The true liquidation value depends on depth, liquidity, and how much supply the market can absorb without collapsing the price. In other words, market cap is a snapshot of marginal consensus, not a guarantee of realizable value. So the next time you see a headline stating that Nvidia erased billions in a matter of minutes, don't get too excited, as it doesn't mean much on its own.